Hi guys, this is Shivanshu here. This will probably be my first video in the world of finance. I plan to make a lot of videos in topics related to finance, philosophy, maybe a podcast conversation with the people, all done in neat playlist. This is not going to be in a playlist video. This is probably going to be an ad hoc video, so bear with me. And I'll try to simplify um, the concept of mutual fund, or at least explain the best I know. So I'm assuming that the person seeing this video knows nothing about mutual fund, and they just have heard this word key. There is something known as mutual fund and they have to invest in it, and whatever I'll be saying in Indian context. Okay, so now let's say you have just started earning. Either you could be working in the private sector or government sector, or you can be working as a freelancer, contractor, anything, right? Etc, etc, etc. But you are making something, you're making some income minus your expenditure is basically, I'm assuming it's saving, right? And after whatever financial as we say commitments, let's say you have some money set aside but you want to invest it. You just don't want it to be sitting idle in your bank account, whichever bank you have, right? So some one friend of yours, maybe your chacha, your mama. Chacha means uncle, right, from father's side. Mama means uncle from the mother's side. Or maybe a friend of yours is saying, bro, let's invest in mutual fund. But you still want to know what a mutual fund actually is. What is the basic funda behind a mutual fund? So if you have to, and not only for yourself, if someone else also asks you what a mutual fund is after this video, you should be easily be able to tell them that, bro, this is the way it works. So what a mutual fund is basically is a lot of people coming together, pooling their money so that they can buy a portfolio, which they couldn't have bought on their own. Let me give an example. Okay, I'm just going to be writing some names here. Let's take HDFC is still quite reasonable, and then Bajaj Finserv, I think. So I don't know the short for it, but we'll take it as Finserv, right? So we have these four shares, right? I'm sorry, my handwriting is a bit better than this, but because of this pencil it's coming like this. So let's say this is about 3.5k. Oh yeah, info edge. And then MRF is, I think, if I'm not wrong, more than even 60,000. That was the last time I checked. It has been a long time since I've checked even these share prices, because I've not been actively investing since quite a bit time. Nowadays I dabble a lot with private equity, unlisted equity, or C-ops and all. So I'm basically exploring a lot of other financial instruments, but let's just take this as 65k, HDFC and all of these. So let's say this portfolio, and of course you wouldn't just buy one share, right? You would want to do a percentage investment. What is a percentage investment? Let's say TCS you want to buy in the ratio of let's say 25%. Then MRF you want to buy, let's say 25% again. HDFC only 10%. And but this is just an example. My suggestion is you should never allocate more than 5 to 10% of your portfolio or your investment in a single share, especially if diversification is what you're looking for. Definitely not. So, and so on and so forth, maybe 5% here and 2.5% here and so on. When you do this percentage distribution, sadly in India we don't have the concept of fractional investment. Fractional investment is, let's say you have you want to buy an Apple share, right? Which is worth, let's say, if I'm not wrong, $139, but you have only $13.9. So you can own, I'm so sorry for this, so you can own $13.9. So you can own 0.1 which is 10% of that share. You can do this in US and with relating to US shares, but in India that is not possible. So the only way is to buy a whole share. So if you want this kind of percentage portfolio distribution, and when fractional share is not an option, you need to bulk buy it, right? I hope you're getting my point, because you want to replicate this portfolio, and these are not some cheap shares. There is a concept of penny shares. If you guys want to Google search about this, and penny shares, there are shares which you'll get for 10 rupees, or even shares for 1 rupee listed on BSE. Lots of shares which are very cheap to buy, right? You can just load 100 rupees to your stockbroker and just buy it on BSE or NSE and just get on with it. But these shares, and these are still, except MRF, I think these are still reasonable. There are many shares which right now are not coming to my mind, which are much more expensive, which a person who, let's say, has just joined a company or has just started their career may not have that much initial investment, but they still want their money to be invested in such good brands and in good, safe portfolios. The only way for them is to pool the money. If I have to give a practical day-to-day example, I'll tell you, go with a plot of land. The simplest, since in India we are known for agricultural and plots. Let's say you're buying this plot of land, some 10 by 10, so let's say 100 square foot land, and it's worth something. Now alone, obviously you don't have the capital enough to buy it, and you don't want to buy it on a loan or on debt. So you and your 5 friends come together and buy it, and then grow this particular plot of land so much, and then you sell it at a profit, and everyone gets their share. I'm assuming everyone invested equally, or even if they didn't invest in equally, proportionally get their returns, right? If, let's say, you bought 100 square foot of land for, let's say, 10,000 rupees, right? And then after, let's say, 5 years down the line, you sold it for 20,000, right? And let's say you and your 3 friends, you invested 50%, and your other 2 friends invested 25 capital cost. Now the cost of this land, you gave 5k and your friends gave 2.5k respectively, right? Then when this became 20k, you will get your 10k, right? From 5 it became 10, and your friends will also get 5k and 5k. Basically, it is possible that because you were in a better place, you were able to invest 50%, but not everyone has the same financial capability at a given point of time. So proportional to their financial capacity, they can now invest. And the beauty about mutual fund is, especially nowadays, you have initial investment starting with 100 rupees per month, right? 100 rupees per month. And before someone says that I mean, come on, 100 rupees is also a lot. I want you guys, actually I don't want to give you the answer, I'll just give you partial answer. So we have only 4 crore, approximately 4 crore. 4 crore is nothing but 40 million, right? 40 million people in our country invest in mutual funds. I want you guys to Google how many OTT is. It's basically like platforms like Netflix, Prime Video, ZTV, all of these which are available in India with their respective fees yearly. Okay, I want you to do this homework. How many are there? So before you tell me even 100 rupees a month is more, which is exactly 1200 rupees a year, I want you guys to do this homework with OTT. You will understand very easily that where the problem lies. It's more about priorities, and believe me, even this 100 rupees makes a big dent on the long run, for which I may keep another video. I don't want to club it with this. So this was basically the concept of mutual fund. I'll also give one more illustration now. The other illustration now which I'll be showing will be basically about how the mutual fund works. This was the concept or the funda, but the real time working, how it works, if I had to give it an example, is, let's say, me and my best friend, right? I don't want so my best friend and his other two friends, and then again my senior, all of us, let's say we club some money, right? All of us have some money, some coins, right? Some coins, we'll put it like this, and then we have bulk of coins here stacked. This is basically the gold coins, or just imagine this as a bulk of money, a lot of money here, which we give to, which we actually don't directly give it to the mutual. I mean, the money directly goes to a fund manager, but it first goes to a fund house. For example, my pet AMC is HDFC AMC. Now, AMC is nothing but is asset management company, right? So an asset management company is basically a company dedicated with handling mutual fund portfolios, etc. So it goes to, and then you have different portfolios under an AMC. It can be, for example, HDFC has its world famous flexi cap, mid cap and or opportunity fund, and then it has some debt instruments like liquid fund, etc. Even though this is altogether another ball game which we'll discuss about later, but these are the three things which these are the subtypes, not just three. There are many funds under the HDFC AMC, and let's say we have picked, because let's say me and bunch of my friends, these are all investors. Just don't imagine this as Shivanshu and his 5 friends. This is basically the entire number of investors under the particular FlexiCap scheme. So they have basically chosen the FlexiCap fund within the HDFC AMC, that what, we like this portfolio and we're going to invest in it. So this money goes here, and then this same bulk is then assigned or given to the fund manager, right? So fund manager, right? And then this guy basically invests in that portfolio, the whole TCS MRF, right? TCS MRF, the whole thing which I showed basically is invested in this, right? And you can check about the top 10 holdings or the whole distribution of stock composition in a mutual fund on their website, or nowadays there are many apps in which you can directly view it. That's your wish, and they update it anyway every quarter or every 6 months, so it's quite accurate and up to the date. Once you do this, right, once this is done, now there is one word which I forgot to mention about, like how you have an IPO in a share, right? Initial public offering, when a share is listed for the first time on the stock market. Similarly, for your mutual fund, there's an NFO, new fund offering. Simple. This new fund offering which we are talking about, this is like how we have IPOs for share. This is when the first time a portfolio is made by, let's say, a fund manager, Mr. XYZ Sharma, right? And then it's listed and it's purchased in a way that will correspond to, let's say the whole portfolio cost was 10 crores. Then it will be distributed by 1 crore unit, and each unit NAV will be 10 rupees. Generally, especially from the 3-4 year trend which I've been seeing, and in India it's a general practice that any NFO which is listed on the share market generally has 10 rupees as the NAV. NAV is nothing but net asset value, which basically represents, like how you trace a price of a share, you track the performance of a portfolio based on the NAV of that mutual fund. It is basically like the stock price, but for that mutual fund. It's basically tracking the performance of the whole portfolio, not of just one share. And that is reflected again on a daily basis. It sometimes might go 10.02, it might go 10.05, then on some bad day it might become 9.95. So that's how it goes, right? And then that's how it gives you interest. So a lot of NAVs which you are right now seeing, maybe 153, 154, but if you see, that will be since inception. If you see, the first price they were listed on was 10 rupees. So basically they have made 150 times, they have generated the wealth. And that's the magic of both compounding and of mutual fund. And obviously, since we don't have fractional investment, SIP in shares obviously exist, but SIP in mutual fund seems to be much more reasonable, because the minimum you need, as I mentioned, starts with 100 rupees, and all the blue chip companies, with an exception of few PSUs, require much more than just 100 rupees. I think National Aluminium is an exception. I think that you'll get around 100, and there are a few PSUs which you might get. But other than that, getting a blue chip company in just 100 rupees a month, buying each share per month, is going to be a very difficult task. So an SIP in a mutual fund, systematic investment plan, as it says, is much easier. So, and this is more than just wealth building, it's actually good for habit building. So I've already covered two. The last, these two things is, um, so now you know the funding, the funda, the central funda, and even the working on a general level. But what is an exit load, if someone had to ask, or these technical terms? See, there are many other things like standard deviation, alpha, beta. I don't want to get into all of that. For that, if you go on YouTube, you have more than 100 videos for that, and you don't need to bother your brain so much with those things. Exit load, however, you do need to know. Sometimes when you buy a particular unit, when you sell a share, the only thing which you have to pay is the DP charges, right? Like, for example, Zerodha has, or actually DP charges are more fixed per broker, plus your government charges, plus in case you have any brokerage um, by your broker charges, right? However, when you are involved in an exit load in mutual fund, things are not so simple. To maintain the stability of a particular fund or house, the fund managers decided, if a particular person is withdrawing their particular portfolio investment before a year, they will be penalized by paying a certain percent of the whole amount they own. Now, a lot of people don't realize 1%, right? 1% of whatever the portfolio value is there. So even if you have made no profit, right? Let's say if you invested 1 lakh rupees, right? And your current value is also 1 lakh. But if you redeem the particular amount of the portfolio before a year, and if the exit load is applied, obviously it will be applied of 1%, then the amount that will be credited back to your bank account will not be 1 lakh. It will actually be 99,000, which is minus 1% of the whole portfolio value. If this was 1 lakh 1,000, assuming that there is a 1% growth, then this will be into 0.99, which is after subtracting the 1% exit load. So I hope you keep that in mind, that it's not so hunky dory, and especially the 1 lakh, you feel a pinch because it's 1,000 rupees. Imagine if this was 10 lakh rupees. So with more money, the difference and the exit load is really felt. Does that mean all funds have an exit load? Absolutely not. A lot of debt funds and liquid funds have zero exit load, and even some of the equity and index funds have zero exit load, or within and only or 3 months lock in. Exit load is nothing but a way of making you logged in for a particular period of time. And a lot of companies even have this condition in exit load, that if you sell 10% of your units, okay, up to 10%, there is no exit load. If it's more than 10% is when you will have to pay the 1% or 2% exit load. Now, I have just given an example of 1%. There are some funds which even charge 2% exit load, and especially with regular funds, or not the very common funds which you have. Okay, now comes the expense ratio. Now I don't want to go too much technical, because this has already been a long video. In simple words, it's basically the fees of the manager. Basically the fees of the manager for taking your money and investing it in a good portfolio and using his brain. The amount of money he's charging, that's it. That is what it's basically what the management is taking for fund management. The definition of expense ratio is that, and it is basically subtracted on a daily basis. But remember the NAV, which whatever is printed on a daily basis, by the way, you whatever NAV is shown, for example, right now, if I see on my coin app or whatever, will be of 7th December, not of 8th December. It's generally a day behind, right? And it gets updated at 11:30 p.m. or 11 p.m. or 10:30 p.m. Depending on which stockbroker or which app you use. It depends completely. So but it's generally at the night, so till morning or evening you'll obviously be seeing the previous day's NAV. So the NAV that's published every day is after deducting the expense ratio, which is charged daily, by the way, obviously, because they're even if they made the portfolio once and they're updating it quarterly, the fund management house is obviously involved in a lot of activities, right? There's a lot that goes in the back end. I mean, if you guys want, I can make a video on that also, like how the cash and cash equivalent you will see sometimes in the stock portfolio, how they manage that, and sometimes the block deals which a lot of mutual fund houses do. There's so much that goes in the background. So for all of that activities, what they're charging you. And generally, I tell people to be a little selfish and not invest in companies which charge them an exit load of more than 2 to 2.5%. If your company is charging you more than this, and especially on regular funds, this amount gets sometimes even more than 3%, because then even if your fund is making 17%, 3% you're giving to manager. So the effective returns you're making is only 14, right? So this will be the same as investing in an index fund, which is giving you a 13.5% return minus 0.5% expense ratio, 13%. It's almost comparable to this. So what extra value add are you getting? And at least index fund has more liquidity, it has lesser lock-in and lesser volatility. You are investing in a particular flexi cap or fund for what reason? Because you want slightly a higher skin in the game and a better return. Actually speaking, even this 1% difference makes a lot of difference in the long run, because not even compounded, even simple for 10 years will be 10% plus compounding effect. If you put 1.1 whole raised to power 10, if you do, this will almost be like 12 to 15% difference in portfolio value, which is still a lot. I am not going to deny the fact that that's also comparable and it's a huge deal. But still, I always tell people to use their heads and not spend a lot on expense ratio. So this basically doesn't cover the entirety or the ocean of subject that's mutual fund investment, but it actually touches upon all the topics. I try to touch upon all the major topics which a person needs to know with zero knowledge about mutual fund. And this video might have gone a little fast paced because I'm not very familiar with making videos on finance, but this was my humble try. So I hope you guys liked it.